Hey guys, why you should or should not listen to me. I'm Eric, I'm from Hong Kong. I lived in Canada, UK, mainland China, and now in Germany. I've been investing since I was 17. Yes, almost 20 years. I invest in all sorts of stuff, mutual funds, stocks, bonds, CFDs, options, you name it. So why am I here today? Because I feel like there's so many YouTube channels about Chinese stocks. They're either focusing on technical analysis or something about the basics numbers, like a PE, PB, growth, or just introducing in general what those companies do. I mean, it's a good thing, it's not a bad thing, but I want to go one step further. I want to give you deeper insights into the real levers of getting profits out of Chinese stocks. First of all is the political economy. China is not a free market economy. It is a socialist planned economy. So what does it mean? I can give you some examples. For example, last year, the government decided that, okay, they do not like movies or TV series about former dynasties. So they took all of them offline. And of course, those companies' stocks were plummeted because their investments into tens of millions of dollars were gone. But of course, it's not always bad. There's always something positive as well. For example, if you were in the renewable energy sector, if you are in the electric auto industry, or if you're in the rail industry, as you know, China has one of the biggest high-speed railway network in the world. And it only happened within the last 10 years. So that's pretty impressive. But what I want to say is that the government policy is to make it or break it decision for most of the businesses, if not all. Apart from this, the speed of decision making and implementation is much faster than the rest of the world. Take electric vehicles as an example. In Europe, probably it would take months, if not years, or even a decade to actually implement that policy. But in China, it could happen within weeks. The second lever is investor behaviors. 99.6% of the investors in China are retail investors. This is totally different from the rest of the world, which are usually dominated by institutional investors. For example, like your fund manager or the pension fund. And some even said that they behave more like in the casinos. Obviously, retail investors have a very different perspective than institutional investors. Even though our main focus would be Hong Kong Stock Exchange or the Hong Kong stock market, Hong Kong stock market is increasingly being aligned with the rest of China in terms of stock exchange. Why? There are three reasons. First of all, many of the companies listed in Hong Kong are also listed in mainland China. It doesn't make sense to have my same company, one stock is worth $1 and the other one worth $2, right? They have to be aligned. Secondly, the Hang Seng Index, which is the main index of the Hong Kong stock market, is going to have a reform to have a much higher proportion being determined by mainland Chinese companies. The third point is there are existing mechanisms that investors in China could invest in a stock in Hong Kong through their stock exchange either in Shanghai or in Shenzhen. So in short, the investor behavior in mainland China is very different because it's retail driven, it's retail investor driven. Even though we focus on investing in Hong Kong stock market is increasingly aligned with the mainland markets because of the three reasons that I've mentioned. The third lever is local insights. Why this is important? Because I saw that very often in the West, the news about Chinese stock markets or particular stocks are really, really high level or abstract. But the difference of making or not making money in the Chinese stock market is that whether you know about the rumor or the nitty-gritty hints that is the government is going to which direction or what is the management thinking about. So this is the key differentiator. So in order to have these key differentiators, We need to have local insights from the news or the columns or even some forums. But on the other hand, I would be lying to you if I said that I had the crystal ball and predict that Ant Financial would not be able to go listing last year. I mean, to be honest, I think most investors, even the most sophisticated investors, would not have any idea that the Ant Financial IPO would be called off the day before, literally the day before the actual listing. I mean, it has already frozen $1 trillion of money of subscription. Of course, many of them were IPO loans, including myself, that I borrowed tens of thousands of dollars in order to subscribe to their shares. Well, you could look at my videos about IPOs, but this is the case. So you should not believe in me if you thought that I have the crystal ball. No one has the crystal ball. I mean, in this case, probably only someone around President Xi would have any idea about that they're going to call off the IPO after years of preparation from Ant Financial. But I think you should listen to me with the key levers that I mentioned: the political economy policies, speed of policies, investor behaviors, and also local insights. With these three pillars, you will be able to do much better than the rest of the world who only has basic technical analysis and basic PE or PB ratio or growth or general understanding of the company. Of course, I'm not saying that numbers are not important, but I think it's even more important for Chinese stocks that you know about the policies implications behind, what are the policies directions, what are the behaviors, mindset of the investors. These are also be important, and the local gossips. This is what would make you ahead of others. Remember, if you like the video, like it, subscribe it, and share it. If you have any questions, feel free to comment.